Have a look at this balance sheet. It shows three assets: stock control, computer and furniture. And most assets in a balance sheet are recorded and reported at their historical cost, the cost to the business entity when they were purchased. However, what happens when, for example, the owner contributes a personal vehicle which had originally cost, say, $25,000, say 3 years ago, for an agreed value of $15,000? Do we record this capital contribution at $25,000? That was the historical cost for the owner as an individual. Or do we record it at this agreed value of $15,000? The owner is separate from the business. So when the owner purchased that vehicle on the 1st of the 1st, 2015, that $25,000 was not the historical cost for the business entity. That was the historical cost for the owner as an individual. So that $25,000 historical cost is irrelevant to the business entity. And that's why we come up with this agreed value, in this case $15,000. It's possible that the owner, perhaps in conjunction with the accountant or an expert in valuation, has come up with this $15,000 figure. It probably or hopefully reflects a very accurate market value of that particular vehicle now. But it still does involve estimation. It still is an opinion, and therefore it lacks the reliability that we normally associate with valuations of assets in the balance sheet. However, this agreed value of $15,000 is certainly more relevant than the historical cost figure of $25,000. Remember, that $25,000 was not relevant for the business entity. That was for the individual, the owner as an individual. So the agreed value, $15,000, it lacks reliability, because there's no precise documentation to verify this value of $15,000. However, stakeholders, people looking at the reports of the business, now have more relevant information about the business, and it would be certainly more relevant than the original $25,000 that the owner as an individual paid for that vehicle. So the general journal entry would be debit vehicle, credit capital, and $15,000. This agreed value is used instead of historical cost because it is a more relevant valuation for stakeholders, and therefore the stakeholders are better able to assess the performance of the business. And if you have a look at the balance sheet extract here, you can see now that the assets are a combination of historical cost assets such as stock control, computer, furniture, and vehicle now, which has been added by a capital contribution. This is at agreed value. So it is not historical cost, it is agreed value. So sometimes the assets are a mixture of historical cost and agreed value.